franking credits are actually a tax credit for company tax that has already been paid by an Australian company. So for instance, you take a Westpac or a BHP or what have you, they're making billions of dollars worth of profits and they pay tax at 30%. So let's just do a very simple example. Let's make it $100 million. They make $100 million pre-tax profit. They'll pay 30% tax, which is $30 million. There'll be $70 million of after-tax profits left over. If that company pays a dividend of $70 million equal to its profits, there'll be a $30 million tax credit if it's paid as a fully franked dividend, which it would be in that case because they've paid the company tax. Now, from an Australian investor's point of view, they actually can use that tax credit to pay tax they would otherwise pay. So what it means is that depending on your individual tax rate, you might actually get a tax refund. So for instance, if you're a pension phase superannuation investor, less than $1.7 million balance, your actual tax rate in a superannuation fund is zero. So you're not taxed at all. But in that case, the profits of BHP had been taxed at 30%. So they've taken 30% tax out, but as an investor, your tax rate's zero. So you actually get the full 30 cents in the dollar refund. You get a refund of all that tax credit. And that's why, when the ALP tried to take away that refund, a lot of retirees were up in arms because it would make a huge impact on their after-tax income if they were retired. And that's why a lot of people are very upset. So franking credits are a very important part of income. I mean, put it another way, if you got a $7 dividend and a $3 tax, there's a $3 tax credit associated with it. So if you're a pension phase super investor, you would actually get $7 cash from the company. And when you put tax return in, you get $3 cash from the government. So actually that dividend's worth $10, not $7. And that's a pretty big uplift.